Welcome back to TradeWins Radio Show and Tuesday morning pre-market update for investors. What an overnight it has been, wouldn't you say? There's this almost palpable sense of relief rippling across global markets this morning, all thanks to some truly significant geopolitical developments that unfolded while most of us were sleeping. Yesterday, there was a real tension in the air, a lot of uncertainty about potential escalation in a critical region. But today, well, it feels like the air has cleared a bit, shifting the market mood dramatically. So today's pre-market is shaping up to be less about new anxieties and much more about immediate reaction. And fascinatingly, a very clear sector rotation. It's a compelling start to the trading week.
Absolutely. The energy on the trading floor is completely different from yesterday, almost as if a heavy weight has been lifted. And for you, our listeners, we're going to dive deep into exactly why that is. We'll start by unpacking some of the big movers in the pre-market, names you'll recognize like Tesla and Nvidia, which are seeing significant gains, but perhaps even more telling, we're witnessing a surprising and swift reversal in, oil prices and defense stocks. Then we'll zoom out to look at the crucial macro backdrop that's driving all of this, those geopolitical developments in the Middle East, and how they're intricately tied to the Federal Reserve's ongoing stance on interest rates. It's a complex interplay, but we'll make it clear. And of course, for those of you looking to navigate this volatility and perhaps capitalize on it, we'll touch on how investors might adjust their portfolios and even share a specific options strategy designed for today's unique and, frankly, still quite dynamic market environment.
Okay, let's unpack this immediately, starting with those overnight futures moves, because they were incredibly swift and telling, almost a knee-jerk reaction to the news. What's striking across all the reports is just how quickly the market responded. Within mere minutes of the U.S. president's late Monday Truth Social posts, the S&P 500 E-mini futures, a key benchmark for broad market sentiment, jumped roughly 0.8%. Now, that might sound like a small number, but for futures in a matter of minutes, that's a substantial move, reflecting a dramatic repricing of risk.
Right, a huge overnight jump like that often signals a real shift.
Exactly. The NASDAQ 100 futures, representing the tech-heavy giants, saw an even stronger pop, about 1%, specifically noted to be up 1.15% at 05:26 a.m. Eastern Time. That indicates a significant surge in tech optimism and a clear risk-on shift. And for the broader market, Dow futures surged by the equivalent of approximately 300 points. This wasn't a gradual climb. It was an immediate collective sigh of relief translated into widespread buying pressure across the board.
What's truly fascinating here is the immediate logic the markets applied to this news and, how quickly traders acted on that interpretation. Our sources highlight that the market quickly interpreted the president's public plea to Prime Minister Netanyahu to bring your pilots home now as a very strong, almost definitive signal. It suggested that Washington was actively and forcefully pressuring both sides to stand down, thereby significantly reducing what traders call immediate tail risk.
That worst-case scenario, basically?
Exactly. Essentially, the small but very real chance of a catastrophic, high-impact event that could derail the entire market, like a broader regional war. This wasn't just a minor blip. It was the market shedding the deep-seated fear of a broader regional conflict, which has been a huge, unspoken overhang for days, and immediately re-engaging with risk assets. It clearly illustrates just how profoundly sensitive the global financial markets are to any perceived de-escalation of geopolitical tensions, especially in such a critical region like the Middle East, where energy supply and global stability are so tightly linked. The speed of that reaction really underscored the pent-up anxiety that had been present.
That rapid shift in sentiment is truly remarkable, isn't it? It's like the market had been holding its breath and then suddenly exhaled. And when we look at individual stocks, we're seeing some clear winners and losers reflecting this dramatic new market mood. For our top gainers in the pre-market, Tesla really caught a strong bid today. TSLA is up an impressive 2.3% pre-market, indicated around $357. This move is particularly significant because it's not only reaching its best level since early April, but also, crucially, it's breaking above its 50-day moving average, which was sitting around $338.
And that 50-day is a key technical level, right?
Exactly. From a technical perspective, that's a very bullish signal, often indicating a shift in momentum from short-term weakness to renewed strength. And the primary driver here, according to our sources, is the exciting news that its robotaxi pilot program is expanding in Austin. That's a huge psychological boost for the stock, signaling tangible progress on one of its most ambitious and potentially transformative initiatives beyond just electric vehicle sales.
Oh. And it's not just Tesla. Following closely, we have AVGO, or Broadcom, up about 2.5% pre-market. This stock is still benefiting from what the sources describe as Apple AI modem chatter, which continues to keep semiconductor stocks robust and bid, meaning there's strong buying interest and a willingness to pay higher prices. The idea here is that if Apple is indeed developing its own in-house AI-powered modems, Broadcom, as a key supplier and innovator in connectivity and specialized chips, stands to gain significantly, either through direct partnerships or by demonstrating its indispensable role in the broader AI infrastructure.
So that AI theme is just persistent.
Absolutely. And speaking of semiconductors, AMD is also showing a strong positive move, up 2.6% pre-market, fueled by fresh rumors of a new MI400 AI accelerator leak. This is critical because AMD is directly competing with Nvidia in the high-growth AI chip space, and any sign of a powerful new product helps them capture market share and investor confidence. The buzz around the MI400 in particular could signal a significant leap in performance, allowing AMD to challenge Nvidia's dominance more aggressively. Together, these three really highlight the persistent and underlying strength in tech and AI, demonstrating that even geopolitical tremors struggle to dislodge the core AI growth narrative. We're also seeing other related moves like Micron, up 2.9% on earnings anticipation, signaling optimism for the memory chip sector. And even Coinbase, up 1.9% as Bitcoin pops above $67,000, signaling a broader return of risk-on sentiment to the crypto space, which often mirrors tech's appetite for risk.
But it's not all green on the screens, is it? We're seeing some equally significant losers and reversals, which are just as telling about the market's current rotation and how quickly it reprices risk. Brent crude, the international oil benchmark, for example, slid more than 3% to its lowest level in 2 weeks. This is effectively unwinding the entire war premium, that extra cost built into oil prices, due to the heightened geopolitical risk and potential supply disruptions in the Middle East that had accumulated over the past week. This premium had been driving energy prices higher, contributing to inflation concerns.
Yeah, that premium evaporated fast.
Didn't it just? Naturally, energy majors like ExxonMobil, XOM, and Chevron, CVX, are feeling the direct impact of this unwinding. They're down about 1-2%, pre-market CVX down 1%, XOM down 1.7%, directly reflecting that sudden crude oil slide on the truce headlines. It's a very direct cause and effect, where a perceived reduction in conflict risk immediately translates into lower commodity prices.
And as money actively rotates out of perceived risk in inflation hedges, we're also seeing defense contractors like Lockheed Martin, LMT, and Raytheon Technologies, RTX, flat to slightly down. They're experiencing profit-taking as the market breathes a collective sigh of relief from the ceasefire news. It's a stark reminder that what's good news for global stability and peace can be interpreted as a reduction in future demand for armaments, leading to profit-taking in sectors that typically benefit from increased geopolitical tensions.
Peace is bad for the defense business, essentially.
You could put it that way, unfortunately. Furthermore, classic safe havens are rapidly reversing course. Gold futures edged lower, and the VIX, the volatility index, often called the market's fear gauge, also significantly decreased, closing yesterday at 21.15. To put that in perspective, its one-month high was only 22.5, indicating that traders are actively fading last week's hedges, meaning they're deliberately unwinding the protective options positions they put in place to guard against a downturn or sharp market volatility, effectively selling off that insurance. Even the dollar gave up its early gains against the euro and yen, another clear sign of global risk appetite returning as investors move out of perceived safety. What this all means is that these specific stock movements illustrate a very clear and deliberate sector rotation. Money is actively flowing out of perceived safe havens, out of energy, and out of defense, and it's pouring back into growth-oriented tech names and other cyclical sectors that inherently benefit from lower oil prices and reduced geopolitical risk. This is a powerful signal of a broader market sigh of relief and a decisive return to the underlying growth narrative that has been so dominant for much of this year.
Okay, so those are the immediate moves. But what's really driving this? Let's zoom out a bit.
Right. What actually triggered all this, and what are the deeper implications that go beyond just the surface-level movements? Let's unpack the critical insights from the sources you shared with us for this deep dive, because they truly lay bare the mechanics of how global events translate into market moves and what that tells us about investor psychology right now.
Absolutely. It's about connecting those dots, peeling back the layers. What's striking across all the reports is that the pivotal event, the absolute trigger for this instantaneous shift in market mood, was undoubtedly those Truth Social posts by the U.S. president late Monday. According to all sources attached, he claimed that Israel and Iran had agreed to a U.S. brokered halt to hostilities, and he even went as far as publicly urging Prime Minister Netanyahu to bring your pilots home now, following specific reports of fresh Israeli strikes.
That was a very public intervention.
extremely public. The immediate implication of this, as our sources highlight, is that markets quickly treated this public high-level plea as an extremely strong signal that Washington was actively and forcefully pressuring both sides to stand down. This immediate catalyst effectively yanked the worst-case scenario and immediate regional spiral off traders' desks. It allowed markets to instantly shed that pervasive fear of escalation and re-engage with risk assets, indicating just how incredibly sensitive the market is to any perceived de-escalation of geopolitical tensions, especially when the news comes from such a high level. This isn't just about a potential truce, it's about removing an existential threat that had been weighing heavily on investor sentiment, freeing up capital to flow back into growth. It speaks volumes about the market's current focus on geopolitical stability.
And the market's response, as detailed by Reuters and Yahoo Finance, was almost instantaneous and quite dramatic, confirming the implications you just laid out. According to all sources attached, Brent crude, as we just discussed, slid more than 3% to a 2-week low within minutes of the news, effectively unwinding what's known as the war premium that had been baked into oil prices. This premium had been a direct consequence of supply uncertainty and fears of broader conflict, acting as a direct inflationary force. Alongside this, gold futures and the VIX, the market's fear gauge, both edged lower, reflecting a broad retreat from traditional safe haven assets.
So less fear, cheaper oil.
Exactly. The immediate implication of this is profound. Cheaper oil significantly cools the inflation outlook. When energy costs decrease, the pressure on consumer prices and corporate input costs eases. By extension, less inflationary pressure reduces the burden on the Federal Reserve, making a soft landing scenario for the economy seem much more plausible, a scenario where inflation comes down without triggering a deep recession. This directly and powerfully favors long-duration growth stocks, names like Nvidia and Tesla, which are highly sensitive to interest rate expectations. When the prospect of higher rates diminishes, the future earnings of these companies are valued more highly today, driving their stock prices up. It's not just a valuation exercise, it's a profound shift in capital allocation, where every dip in inflation outlook acts as a direct subsidy to the future value of growth-oriented innovators, fundamentally altering how investors assess value in a volatile world. It essentially re-rates the entire growth landscape.
That's a fascinating insight, that a dip in inflation acts as a direct subsidy to growth stocks. It really highlights the interconnectedness of these global factors. What's also clear, even amidst these geopolitical shifts, is the enduring strength of AI and mega-cap momentum. According to all sources attached, this continues to be a truly dominant force in the market, often overpowering other narratives. Growth leadership, including perennial powerhouses like Nvidia, Microsoft, Apple, and Tesla, remains the default place to park cash whenever macro shockwaves recede.
Almost like a safety trade within tech itself.
Right. The implication here is fascinating and goes beyond simple risk-on behavior. It suggests a deeply resilient underlying narrative in the tech sector. It's almost as if the market sees these tech leaders as a different kind of safe haven, a place where future growth is almost guaranteed once the immediate global jitters subside. Traders aren't just reacting to the geopolitical news in isolation. They are incredibly quick to rotate back into these established leaders, almost as if making an implicit bet on AI as a structural disinflationary force, capable of offsetting geopolitical inflation spikes by driving productivity gains and cost efficiencies. This indicates that the long-term structural plays around artificial intelligence and technology continue to powerfully influence market flows, often proving to be a stronger, more enduring force than even day-to-day geopolitical headlines. It really highlights the market's conviction in this long-term technological transformation, almost a gravitational pull for capital.
However, here's where both Reuters and the Yahoo Finance live blog inject a crucial, almost urgent warning. According to all sources attached, while the market is undoubtedly reacting positively to this apparent de-escalation, fresh missile reports out of Tehran indicate just how incredibly fragile this truce actually is, keeping headline risk elevated. This means that while the immediate tension might have dissipated, the underlying instability has not. The implication here is critical for every investor. This advises us to fade the panic, but don't chase the rally.
Meaning don't get too carried away.
Exactly. What this really means is that while it might be prudent to trim some of the hedges, those protected positions you put on during the peak of fear, and perhaps nibble at cyclicals that benefit from stability, it is absolutely essential to keep position sizes modest. The message is clear. Do not go all in until this truce proves to be sustainable and concrete actions on the ground confirm the de-escalation. Prudent investors should be scaling in gradually, building positions cautiously, rather than jumping in with both feet, because the situation could flip on a dime. This emphasizes the need for continued vigilance despite the current relief, recognizing that the situation in the Middle East is inherently unpredictable and subject to rapid shifts. The market might be celebrating, but the foundations are still shaky.
That's such a powerful phrase. Fade the panic, but don't chase. It's a classic market adage that really applies today, reminding us not to get swept away by either extreme. And further driving this cautious yet opportunistic approach, according to all sources attached, the investor reactions noted in the live blog show a very clear rotate rather than retreat mentality. This isn't just money broadly rushing back into the market, it's actively flowing out of energy and defense sectors, as we've seen, and specifically into tech, housing-related cyclicals, and consumer discretionary names.
Sectors that like lower oil and stability.
Precisely.
Yeah.
These are all sectors that significantly benefit from lower oil prices, which reduces their input costs and boosts consumer spending power, as well as from a more stable economic outlook, which encourages discretionary spending and housing activity. The implication here is that this isn't merely a broad market rebound. It's a strategic reallocation of capital, a deliberate shift towards segments that thrive in an environment of easing geopolitical tensions and potentially lower inflation. It signals specific opportunities in companies that stand to gain from reduced energy costs and a more favorable economic backdrop, potentially allowing savvy traders to surf tech momentum while intelligently hedging against a potential oil snapback, recognizing that the underlying tensions haven't fully evaporated even if they're momentarily calmed. It's a nuanced dance between offense and defense, and savvy investors are already making their moves.
Finally, and this is a major point that will shape the market throughout the day, according to all sources attached, the consensus indicates that a key factor influencing ongoing market sentiment today will be the Federal Reserve. There are no fewer than 6 Fed speakers scheduled throughout the day, in addition to Chair Powell's testimony, meaning we'll get a deluge of perspectives and potential nuanced language from various regional Fed presidents and governors. Crucially, futures markets are currently pricing in a 42% chance of a July rate cut.
That's still less than 50-50, but it's significant.
It is. The implications of this are enormous. Any dovish hints from these Fed officials, any language that suggests a more accommodative stance, perhaps indicating that they are more confident in inflation moderating or that the job market is softening just enough to warrant a rate cut, could significantly fuel this relief rally. Such hints would reinforce what is often referred to as the soft landing plus AI boom narrative, where inflation comes down without a deep recession and technology continues its strong growth trajectory. This could lead to lower bond yields, which in turn lifts the equity risk premium, making stocks comparatively more attractive and potentially extending the market's current upward trajectory well beyond today's initial reaction. So all eyes will truly be on the Fed's commentary because that could be the next big catalyst to either confirm or challenge the current market optimism.
That deep dive into the Fed's potential impact is critical. Given everything we've just discussed, the relief, the rotation, and the lingering fragility, how can investors actually position themselves? Let's move to our strategy corner and talk about some concrete plays that could benefit from this unique market setup. Today, with volatility easing a bit and that cautious optimism we've been discussing, one high-probability options play that aligns perfectly with this bad news is less bad than feared market sentiment is a SPY bull put credit spread for the near term. This is a neutral to slightly bullish strategy designed specifically to benefit if volatility continues to leak out of the market or if the market simply holds steady or drifts a little higher. It's about collecting premium while defining your risk, a great way to express a view when you expect calm to prevail and implied volatility to decline, eroding the value of options.
Okay, let's break down the specifics of this SPY bull put credit spread for you. This particular trade has an expiry of Friday, June 28, 2025. This short expiry date is chosen intentionally to capitalize on accelerated time decay, which rapidly erodes the value of options as they approach expiration. It involves 2 legs. You would be selling the $5.95 put, aiming to collect an approximate credit of $1.80, and simultaneously buying the $5.85 put for an approximate cost of $0.80. This gives you a net credit of approximately $1 per contract, or $100.
So you get paid up front to put the trade on.
Exactly. For context, SPY was trading around $605.28 pre-market. Your break-even point on the strategy is at $594, which provides about a 1.9% cushion from the current spot price. This means the SPY ETF could fall by almost 2% and you would still break even on the trade. The maximum gain you can realize is the credit received, which is $100 per contract. Your maximum loss, however, is limited to the width of the spread minus the credit received, which translates to $900 per contract. That's a $10 width between the strikes minus your $1 credit. Looking at the probability, the short put has a delta basis of approximately 0.18. This isn't just a statistic. It means that based on current market assumptions and implied volatility, there's roughly an 82% probability this option will expire worthless. We target this higher probability because in a market easing off fear, we're looking to consistently collect premium from diminishing volatility rather than making a big directional bet. It's about playing the odds in your favor for consistent income as the market digests the news and volatility subsides.
That's a great breakdown of the mechanics and the rationale behind that 0.18 delta, which, as you explained, gives us a very high probability of success in a stable market. Now let's talk about managing this trade, because even with defined risk strategies, you need a plan, especially with the lingering headline risk. For potential adjustments, we'd advise considering rolling down or rolling out this spread if SPY closes below $600 today and the VIX spikes above 25. Those are your key triggers for a defensive move. If the market breaks a key psychological level, like the $600 mark for SPY, and volatility returns sharply, indicated by the VIX spike, it's time to adjust.
So specific triggers to watch for.
Exactly. Rolling down means moving your strike prices lower, and rolling out means extending the expiry date, both aiming to give the trade more time or a better chance to recover or limit further losses, essentially buying yourself more time or a wider margin of error. As for an exit trigger, consider closing the position early if you capture 50% or more of the premium received. That's a strong profit target for a quick trade like this, allowing you to lock in gains and redeploy capital. Most importantly, for risk management, we need to reiterate that even with defined risk strategies, headline risk remains elevated. That truce, while welcome, is fragile. So emphasize the importance of keeping position sizes modest relative to your overall portfolio size and being prepared for quick exits if the narrative shifts again. This isn't a set-it-and-forget-it trade. It requires active monitoring and discipline.
Right, active management is key. And for those of you with a higher risk tolerance or who are keen to capitalize on specific momentum, especially in the relentless AI space, we have an aggressive directional alternative. The NVDA momentum call debit-spread. This is a short-term aggressive play, also expiring Friday, June 28, 2025. This short expiry also means you're betting on a quick, immediate move as time decay will work against you if the stock trades sideways. For this spread, you would buy the 150 call at approximately $2.40 and simultaneously sell the 160 call at about $0.90. This results in a net cost, or debit, for the spread of approximately $1.50 or $150 per spread. So this one costs money to enter, unlike the credit spread. That's right, it's a debit spread. Your break-even point for this trade is roughly $151.50, meaning it requires about a 4% up move from current levels for you to start seeing a profit. The maximum gain, should NVDA reach or exceed $160 by Friday, is $8.50 per contract, representing a significant return on your initial debit, around 5.6 times your risk. For risk management, we'd advise cutting this trade if NVDA shares close below $143. We stress that while this strategy targets the significant AI momentum, it does carry defined risk, meaning your maximum loss is capped at your initial debit. However, it needs a quick pop in the stock to be profitable within this short time frame. So active management is absolutely key to its success. You're essentially betting on continued immediate strength in Nvidia, using options leverage to amplify potential gains within a very tight window. High conviction short-term play.
Okay, two distinct strategies there depending on your outlook and risk appetite.
Now, let's turn to some of your questions because you're clearly thinking critically about these developments, and we love that engagement. We have a listener asking, with all this positive news about a ceasefire and the strong pre-market moves in tech like Tesla, should investors feel confident that the market's path is now clear for sustained gains, or are there still lingering risks we should consider for the rest of the week?
That's an excellent question, and it gets right to the heart of today's complex market. We can certainly acknowledge the market's collective sigh of relief. Our sources clearly indicate that the Trump-brokered but fragile Israel-Iran ceasefire temporarily pulled that worst-case tail risk off the table. That's why we're seeing this rush into risk assets and an unwind of those fear hedges. However, and this is where prudence comes in, both Reuters and the Yahoo Finance Live blog issue a very direct warning. Fresh missile reports out of Tehran show exactly how fragile this truce is. This means headline risk remains elevated.
So the release might be temporary.
It might be. So, while traders are advised to fade the panic, meaning don't chase the fear trade that pushes safe havens higher, they are also explicitly told don't chase the rally in a reckless way. It's paramount to keep position sizes modest right now. This suggests remaining nimble and, crucially, scaling into positions rather than going all in on any perceived clear path forward. It's about using defined risk option structures, like the ones we just discussed, to express short-term views while keeping powder dry in case those headlines flip the script and bring back uncertainty. It's a chess game, not a sprint.
Yeah, absolutely. To add to that, a prudent investor's approach right now should embody what we call barbell exposure. On the offense side, you want to continue to favor those strong AI semiconductors, names like Nvidia, Broadcom, and AMD, alongside quality cloud companies like Microsoft and Alphabet. These are the growth engines that benefit disproportionately when macro concerns ease and capital flows into future-oriented themes. But equally important is the defense side of the barbell. Maintain exposure to cash flow-rich staples like Procter & Gamble and Johnson & Johnson. These provide stability and predictable returns when markets get choppy, acting as a ballast for your portfolio. And don't forget short-duration T-bills, which offer liquidity and a safe place to reload your positions if headlines darken again, providing flexibility if the market narrative shifts abruptly. Finally, as we noted earlier, pay very close attention to those Federal Reserve speakers throughout the day. Their statements could significantly impact interest rate expectations and, consequently, the market's direction, potentially adding more fuel or throwing cold water on this relief rally. The market is incredibly dynamic right now, and staying informed is your best defense and offense.
Speaking of staying informed, we have another great question from a listener asking, given how quickly the market reacted to those presidential posts, what does that imply about the reliability of information from non-traditional sources? And should investors be extra cautious about headlines from any single source? It's a pertinent question in today's rapid-fire news cycle.
That's a really insightful question because it touches on the very nature of information dissemination in the digital age. What we saw was an almost instantaneous market response to a Truth Social post, which is certainly a non-traditional communication channel for such sensitive geopolitical news. The implication is profound. In today's interconnected world, market participants, particularly the high-frequency trading algorithms, are processing information from all available channels at lightning speed. It speaks to the efficiency and sometimes the hypersensitivity of these systems and human reaction to perceived shifts in high-stakes situations.
So algorithms are reading Truth Social now.
Well, they're certainly reacting to the data feeds generated from it. Does it mean you should be extra cautious? Absolutely. Our sources, like Reuters and Yahoo Finance, provide immediate reporting but also issue crucial cautions about the fragility of the news, for instance, by mentioning those fresh missile reports out of Tehran. This highlights that while the market reacts to initial signals, deeper, more vetted reporting from established news organizations is crucial for understanding the sustainability of any de-escalation. So, it's not about discounting a source entirely, but recognizing that initial headlines, regardless of origin, can move markets, while sustained trends and long-term investment decisions require deeper analysis from a breadth of reliable, often cross-referenced sources. It's a powerful reminder that context, verification, and a multi-source approach are more important than ever.
That's a crucial point, the difference between an immediate reaction and a sustainable trend. It really underscores the need for diligence in our information consumption. The views expressed are for educational purposes only and do not constitute investment advice. Always do your own research.
Enjoyed the insights? Subscribe to TradeWins Radio and share the show with your friends. As you go about your day, consider this. If market reactions are so profoundly swayed by temporary de-escalations, often based on quickly published, sometimes unverified information, what does that tell us about the underlying stability or perhaps the inherent fragility of our globally interconnected financial system? It's food for thought beyond just today's trading, delving into how information, perception, and capital flow in our modern world and what that means for future volatility.